Run us through the sense you're making of market activity right now.
Thank you very much, Alishia, for having me today. The market, like you mentioned earlier, went down last week. Went up marginally last week, but week on week, it went down by 1.4%. Between Monday and Wednesday, the market depreciated, but I think the investor sentiment about taking position ahead of the rally which they expect in the market caused the market to appreciate marginally between Thursday and Friday. But week on week, the market still went down by 1.4%. But I think looking at this week, we think there may be some marginal appreciation, not so much because we think the impact of the Monetary Policy Committee meeting that was held last week is still been felt in the market. So we expect the market to just trade sideways this week.
Is the volatility set to be the name of the game, though? Because if we're looking at some of the rescued players and their performances specifically, it's been pretty up and down, with investors coming in hard and fast and picking up stock, trying to pick up bargains, and then selling out on the back of profit taking.
Yes, the way the market operates is such that maybe 1 week of depreciation thereafter will be followed by another level of investors' sentiment being improved in the market and try to take position again. But like I mentioned, the depreciation that we recorded last week and the last 1.5 weeks makes a couple of stocks, attractive at the moment. And again, like I mentioned earlier before, a lot of people, both institutional investors and the foreign investors, are looking at the outcome of the possible what will happen after election in 2011. And so I think this is the time for them to actually position. And it appears that things may likely work well in next year. So people are just, investors are just taking position ahead of the good, benefits in 2011.
Let's take a look at the banking space specifically, because we had, a lot of these banks seeming to be crawling out of the red zone at this stage of the game. And we had First Bank, Zenith Bank, UBA and GT Bank emerging as the highest earning banks in the third quarter of 2010. With that, how are you playing the banking space right now?
Yes, I think the banks that you mentioned are more like the leaders in that subsector. And I think we see values in them, especially in First Bank and GTB. Our latest rating on Zenith Bank, when the price was about valuation about 15, currently it's trading about 14. Investors can have some little room to play in there. But aside from those ones that you mentioned, there are a couple of opportunities looking at the valuation, the P ratio. A number of them don't actually have P ratio now, because what we report at the moment is trillion P ratio, because they recorded a lot of huge losses in the financial year ending December 2009. So, but if you look at what they are likely going to have in 2011, at the end of this financial year, given the result they have released so far and the transparency that we think has returned to the sector, we think that a number of them will trade in the region of a P ratio, forward P ratio about 11 times earnings, which I think is attractive. If they have a P ratio of 13.5, times earnings, they are attractive at that level. So apart from that, those ones you mentioned, we have Skybank. It's a good one that investors may look at there, apart from the rescued bank, which are currently are looking for recapitalization.
In the meantime, quite a few companies coming out with earnings reports as well, amongst them Guinness Nigeria, and it published Q1 numbers for 2011 showing that, yes, sales growth is still weaker than the over 20% that was recorded for the first quarter of 2009, but highlighting that it may well be a positive road ahead. What's your view on Guinness Nigeria?
I think Guinness sometimes last year restructured their operation. They moved to another plans, and they tried to refurbish it in order to ensure efficiency. It's a leader alongside with Nigerian breweries in that subsector, and I think they are doing pretty well. But the major challenge which we have identified in that subsector in brewery businesses in Nigeria is the growing telecom services in Nigeria and product in Nigeria where that is taking a chunk of investors' disposable income. But then if you look at the population of Nigeria and the fact that a lot of people are drinking both alcoholic and non-alcoholic drinks in Nigeria, they have good business and they have good business model. They are highly efficient, and so we expect in the second half of the second quarter result to be an improvement over that one. But at the current valuation, I think it's fairly priced. I do not see so much of price appreciation given the current price.
Where Guinness's top-line performance is similar to its rival Nigerian breweries, I mean, compared with Guinness's 18.4% year-on-year growth, we had Nigerian breweries reporting a 17% growth. How are the two stacking up next to each other in your books?
Yeah, like I mentioned, Nigerian breweries, I think at the current price as well, is fairly priced. At the moment, we expect that the investors should hold it. If you don't have it, don't buy. If you have it, just hold it because of the dividends that we expect them to pay at the end of the year. The two of them are actually income stock. In the last few years, about 2-3 years ago, Guinness was paying good dividend. In fact, excess dividend beyond the earnings they were making in the year because they have surplus cash in their account they want to give to investors. Nigerian breweries as well has been paying this year. I think they paid about 115 kobo as the interim dividend at end of, I think, first quarter, which is very good. We expect that they will pay about 2 naira to end the year, and so investors are buying this as well, institutional investors, because of the good dividend that they are paying and improve their cash flow. So, but I mean, at the moment we place a hold on Nigerian breweries. Why? I think given the current price of Guinness as well, we don't think it has so much room for appreciation.
Let's move on to Flourmils. It was out with second quarter numbers as well. What did you make of those? What have been your overall impressions?
I think for Flourmils, it's an impressive company, and currently you are aware that they're trying to raise about 35 billion naira bond in the first tranche of the bond program they are doing in other words to refinance their short-term loans and in order to embark on expansion. Given the fact that they is like a conglomerate that is into packaging, is into building cement manufacturing, into flour milling, the largest in Nigeria, what they are doing at the moment, I think it's a good one. At the moment, the price is underpriced. We think the price should be in the region of 90 naira, and if you factor in the expansion program they are doing, I think it has good prospect if they are able to raise the money they are currently raising at the 10 to 12% coupon rate.
Of course, they are looking to diversify even further, going into sugar production specifically. What are you making of that strategy as this business diversifies more and more?
I think for us, it's a good one for them. They just want to integrate, backward integration, in order to enable them to produce, the part of the raw materials they use and input into use into other production, which to a large extent, if it's successful, it will reduce their cost and it will make them to have control over the input they use for their final product. Then again is the fact that the dominant it may not be easy for them actually, because the dominant company that's in sugar company in Nigeria is Dangote Sugar, and it has a lot of experience in that area. In fact, we gather that is it contributes about 70% of the market at the moment. So for Flourmils to actually penetrate in terms of selling to retail investors and all of that, it may be a bit difficult, challenging, but in terms of being able to integrate and use it to support the other food businesses that they are into, I think is a good strategy. It may help them to reduce cost, and overall the group will make additional profit as if it is successful.
Ayodele, where we see this company becoming more and more of a conglomerate, do you see this company going down a route like Dangote, the Dangote Group, separating its various components of its business separately on the NSE?
Yeah, absolutely. There is possibility for them to do that. And as a matter of fact, that's exactly what UAC is currently doing, trying to onboard the subsidiaries and the division there to have a holding company structure. But I think that's not a problem, really. As long as they are into good business, the products are selling, that has good demand in the market, even if they onboard it and they have a kind of a holding company structure.
Mm-hmm. We're potentially looking at unlocking shareholder value here.
I didn't get your question, please.
We're potentially looking at unlocking shareholder value here.
Yeah, I mean, yes, what I'm saying, that I think it's a good one. If the issue of unbundling the divisions is not really major, it's not a major problem. Like we said, all the segments of the businesses where they operate, they are good businesses. There is huge demand for cement in Nigeria, flour in Nigeria, packaging materials in Nigeria. These are good businesses they are engaging in. And if they decide to say, we want to onboard these divisions and want to have, you know, a holding company structure, as long as the subsidiaries can run well, I think it's not a major problem.